Different subject now. Let's go to property investment loans, and in particular those that have been taken out with interest-only loans. The Reserve Bank Deputy Governor, that is Michelle Bullock, today indicated that she believes that there are risks to the financial stability of Australia posed not by owner-occupiers, in other words, those people who own their homes and have home loans, but in fact by investors, and in particular those investors who have interest-only loans. A part of the reason for it is the number of new interest-only home loans due to expire over the next 4 years, especially on those held over negatively geared property. A man who watches these markets and interest rate markets in particular, Martin North from Digital Finance Analytics. Many thanks for your time, Martin.
Hello.
So just explain, what is Gillian Bullock's concern about interest-only loans, do you believe?
Okay, so interest-only loans are those where people are only paying back the interest on the loan, no capital reductions, right? So the loan doesn't go down over time, and that means that people have been able to get larger loans to start with, and they don't necessarily have to worry about repaying a capital amount. But the problem is that that may be okay in a rising market where the capital value of the property will ultimately perhaps be able to cover the cost of that capital repayment, but in the current environment that may not be the case, and so there are much higher risks in interest-only loans, and in fact in the UK it's about 4 times the risk of a standard loan from the analysis that they've done there. So what it means is that we've got a lot of people with interest-only loans now. Now, what's happened is that over the last 6 to 12 months, the lending parameters have been tightened. So a lot of these people are going to have their checkpoint review for their loan, which is perhaps 5 years after getting the loan. And now the banks may well turn around and say, well, sorry, you don't now qualify for another interest-only loan.
In other words, if they had to pay back principal as well as the interest on an annual basis, their repayments might rise and rise very sharply, and as a result they might be stretched financially if they've got 4 or 5 or 6 properties that they've bought.
Yeah, so typically they would double. So the repayments would double immediately, right, if they move from interest-only to principal and interest. But if you're right, if you have multiple loans, and you can imagine the impact of that, and of course the other factor to bear in mind is that rental streams are also pretty compressed at the moment. So about half of investment properties are underwater from a cash flow perspective already. So you put those things together and you begin to realize that there's a big problem. There's about 60 billion worth of loans, from my calculations, that will fail to pass muster as they fall due over the next 2 or 3 years. That's a big number.
Okay, one of the things that the financial regulators did was to try to slow down the pace of lending to investors in particular. And so as a result, they really forced the banks to slow down the lending. The banks raised interest rates accordingly. And as a result, in some banks now you can start to see, and lenders, the rate of lending has clearly slowed to the point at which they have now started to cut interest rates on some of these investment loans. Do you think that this would be seen to be a positive thing by the Reserve Bank and the banking regulators?
No, I think that there is a level of concern about the proportion of loans that are for investment purposes. 36% of all loans are for investment purposes. That's massively higher than in the UK or in other countries, right? So we've got a very high proportion. But the point is that the capital appreciation that was there is not there now, and the economics in terms of cash flow is also a bit dicey now as well. So there are much higher risks, and in fact, APRA's paper last week that came out on capital ratios made the same point. There are systemic risks simply around investment loans and interest-only loans, and therefore any growth in that sector, I think, would be regarded pretty negatively by the regulators.
Martin North from Digital Finance Analytics on that subject, which is really interesting to a lot of people right now. And in particular, I'd suggest to many homeowners who have maybe taken out interest-only loans, your bank will be highly critical of you when they come to review that loan in the future. So be prepared. There may be higher payments ahead of you, and especially for many investors out there who have decided that this was a quick and easy way to try and make some cash, just be a little concerned about the repayments down the track as well. Martin North, we appreciate your time.
Thanks.